Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Headlines we are tracking at this hour. This is the show where our team at CNBC TV18 gets you the top stories of the day. I'm Mitali Patel and you're watching Reporter's Diary. Let's get straight on to action from Dalal Street. The markets ended the day on a positive note for the second consecutive session, marking a continuity in its upward trend for the March series. The Sensex led from the front, gaining more than 300 points in trade. The Nifty saw meanwhile continue to surge throughout the day, ending the day with gains of 0.4%. My colleague Anuj Singhal joins us now with a wrap of today's trading session. Anuj.
Well, good day for the markets. The March series clearly has started on a much better footing and the bulls are roaring back. Second day of century for the Nifty and more than a triple century for the Bank Nifty. Intraday, of course, the Nifty did cool off a bit in the last 15 or 20 minutes. But still, it was decent gains over there. Banks, autos, they were the ones which were leading the move today. Of course, IT was seeing some profit taking. In fact, in terms of stocks, Maruti perhaps was your stock of the day today, up 4%. Larsen Toubro, Tata Motors, and then, of course, the large financials, IndusInd, Axis, Bajaj Finance, Kotak, HDFC Bank were all surging in trade. On the losing end, Sun Pharma was down and some profit taking in TCS and Infosys after the recent move. In the F&O space, there were some big gainers like Chennai Petro, Torrent Power, Equitas and Ujjivan, Voltas, and of course the ADAG pack like Relnevel and Reliance Communication. Of course, we have to talk about Oriental Bank of Commerce. That stock was down 10%. The market right now does not like anything to do with the PSU banks. And on this, of course, there was some news as well. All in all, you'll have to say that the bulls own this day as well after Friday. Now the market runs into congestion though. Last time, we topped out at somewhere around 10,640. That's also the 20-day moving average. Let's see if that's taken out or not.
Thanks for that, Anuj. Meanwhile, we understand that the government is gearing up to introduce a new law, the Fugitive Economic Offenders Bill, in a bid to checkmate absconding corporate defaulters. The Law Ministry had already approved the draft bill in September last year. But now, Money Control learns that in the wake of the 11,400 crore rupees scam at PNB involving Nirav Modi, the government does not want to waste more time and wants to introduce it in the second leg of the budget session itself. Gaurav Chaudhary joins us now. Gaurav, how does the bill propose to tighten the noose around the absconding corporate defaulters?
The first draft of this was made sometime in May by the Finance Ministry, which was subsequently sent to the Law Ministry. The Law Ministry vetted it sometime in September, and it has remained at that. In the meantime, the 11,400 crore scam involving Punjab National Bank and celebrity diamond trader Nirav Modi has broken out, which has taken the country by storm. So the government is now of the view that it's about time to fast-track this bill, legislate it, and make it more difficult for people to run away, in the sense that the provisions of the law are going to act as major disincentive for people to run away. It will allow investigating authorities like the Enforcement Directorate, the Central Bureau of Investigation, the Serious Frauds Investigation Office, and the Income Tax Department, and even Economic Offences Wing of the state police departments to actually attach properties and assets and sell these without going through a lengthy judicial process. The bill, the provisions of the bill allows for setting up a special court that is going to quickly decide on how and when properties that are attached by investigating agencies can be sold out to recover dues of corporate defaulters. And this loan is going to deal only with those who have fled the country after defrauding banks or committed some kind of an economic offense. The economic offenses defined in the bill includes a wide range from cheating and forgery to tampering of electronic records, as well as presenting of wrong, as well as defaulting on bank loans, which would include probably people like Vijay Mallya. We do not know yet whether the bill will be, or the law once enacted, will apply retrospectively. What is a possibility, however, is that once the special court is set up, all existing cases, all cases that are currently outstanding in various courts in the country may be transferred to the special court, which could actually bring its jurisdiction to cases like involving Vijay Mallya and Nirav Modi also.
Thanks for bringing us up to speed with the development. Now, while the probe into the PNB scam gathers steam, one of the biggest concerns within the banking industry is who will pay for the fraud? We put forth this question to SBI Chairman Rajneesh Kumar, and he expects PNB to pay for the LOU exposure that his own bank has in the Nirav Modi case. Here's an excerpt of that exclusive conversation.
As far as our exposure is concerned on Punjab National Bank, so that number is very much confirmed, calculated and advised to the Punjab National Bank. And our exposure on one of the companies, Gitanjali Gems, that also has been crystallized and there was no issue around that. So our numbers, our claim is clear, but because there are some secondary market purchases, so double counting has to be avoided. And that is where I think only PNB can give you a confirmed number.
No, I agree, sir. In PNB, what we have got is that 11,400 odd crores of one kind of exposure and another 1,700 crore exposure to Gitanjali. So we are working with something like 13,000 crore. My question is that are there other diamond companies, or either because of a follow-on effect or because all banks have gone and done a thorough search? Should we expect that there will be other, either wrong cases of lending or, manufactured LOUs without a credit memo? Any such problems are they likely to emerge? After all, the IBA met over this issue.
So I don't think so. It seems to be a case confined to the particular branch of Punjab National Bank. At least for State Bank of India, I can confirm that there is no such issue, no such problem. And I'm sure by now all other banks have also would have reviewed their portfolio and would have arrived at the similar conclusion, because if something was wrong somewhere, by now I presume it would have come out.
Okay. So the other thing that has come from the Reserve Bank, I believe are circulars telling banks that they have to connect their SWIFT communication system to the core banking system in cases where they are not. I know you all are not involved. Any other instruction from the regulator on this?
No, other than whatever they have said about the safety of the SWIFT and the controls which need to be in place. So nothing else we have heard as of now. And
deadline of April is possible to do this. It's not very difficult for the entire banking system to comply.
Very much.
Okay.
Very much.
Has the regulator or the government or PNB itself decided who will pay that 11,400? Bankers, when we last heard, there was still some argument between PNB on one side and other bankers.
So I am very confident that things will get sorted out between PNB and the other banks.
Okay. You are expecting them to pay you?
That is my expectation, of course.
Okay. No, but clearly the government or RBI have not come out with anything? They have not intervened?
Not to my knowledge.
Okay.
Staying with the theme of financial institutions, the Financial Intelligence Unit, or the FIU, under the Finance Ministry has released a list of nearly 9,500 non-banking financial companies, or NBFCs, which have been categorized as high-risk financial institutions. Surbhi Upadhyay joins in with all the details. Surbhi, take it away.
FIU's list of 9,500 odd entities really does throw up some interesting names. I'll start with some of the listed companies first. And you have names like McDowell Holdings crop up here, something like TCI Finance, SE Investments, which is now known as Paisalo. And then there are, of course, smaller entities there as well, companies listed on the BSE like Capital India Finance, Interglobe Finance. These are really small companies with market cap of just 15 to 20 crore odd rupees. The harder issue was to try and ascertain whether any of the entities present on this list were related or linked to listed companies or listed groups. So we started digging around a little bit. For instance, Reliance Commercial Finance. So when we reached out to Reliance Capital to find out if there's a link here, Reliance Capital told us that Reliance Commercial Finance was merged into Reliance Capital back in 2011. Again, one entity known as DLF Finvest. So when we reached out to DLF, DLF did confirm that this is a subsidiary. However, DLF calls this a dormant subsidiary of the company, which does not take any loans from the public or from banks. It's not lending to any third party. That was DLF's clarification. Similarly, there's an entity called Welspun Finance. So when we asked the Welspun group about this, they did acknowledge that yes, that this is a subsidiary. However, also went on to say that Welspun Finance has already submitted or surrendered its certification to the RBI, and it's no longer undertaking any sort of NBFC activity, and it's also not linked to any of the listed Welspun group entities. Now, these were some of the companies that came back to us. There are lots of names that are still out there where we are still awaiting responses. For example, an entity like Minda Finance. We are yet to hear from the Minda group as to whether there is a link. A company known as Radico Khaitan Finance. Again, we're waiting for the Radico Khaitan group to get back to us. Magna Consumer, GMR Enterprises, Centrum Financial Services, ASK Financial Holdings. So there are lots of names out there. What's interesting is that the FIU obviously has only put out a list. It's a red flag of sorts. We don't know what sort of regulatory action this would be followed up by, because the terrain is really ultimately the RBI's. So are these companies going to be barred from, further perhaps, giving out loans? Will there be certain penal provisions? Will there be any penalties, any restrictions imposed on them? That is something that's not clear from the FIU's press release or the FIU's notification. We'll have to see how the sector regulator responds to this.
Surabhi, thanks for that. Let's take a very short break here. But coming up on the other side, another legal setback for the Singh brothers. Delhi High Court attaches assets of their holding companies, RHC Holdings and Oscar Investments. Details when we get back. Stay tuned. Welcome back. Now there's no respite in sight for Fortis Healthcare's Singh brothers. The Delhi High Court attached all the assets of RHC Holdings and Oscar Investments. Remember, these are holding companies of Malvinder and Shivinder Singh. Ashmit Kumar, who has been tracking the story since the very beginning, joins us now with more details. Ashmit.
Well, indeed, no relief in sight as far as Singh brothers are concerned. The pain continues for them. The Delhi High Court going a step further and attaching the assets of their holding companies, that's RHC Holdings as well as Oscar Investments. Now, all of this is in pursuance of the Daiichi 3,500 crore arbitral award, which has been upheld by the Indian judiciary right up till the Supreme Court, in fact. And now the question of execution arises. How, when, if will the Singh brothers pay up? That is a question being tackled. The Delhi High Court, in pursuance of answering that question, has number one directed both these holding companies has attached all their assets which they had submitted as a part of an affidavit before the Delhi High Court itself last year. Now, at the time of submission last year, those assets were valued at 3,200 crore rupees. The total demand being made by Daiichi is 3,500 crore rupees. That's part one. The second part is both these holding companies, they have been restrained from being allowed to work their own bank accounts except for payment of salaries and payment of statutory dues like taxes. And herein comes the third part. Even the Singh brothers. The Singh brothers have now been directed by the Delhi High Court to submit a list of their personal unencumbered assets, and they will have to do so on or before March 23rd. Now, keep in mind, just to give our viewers some perspective, just a single day's delay is costing the Singh brothers an interest cost of 50 lakh rupees. So that's the sum that they're looking at. They have to now disclose their personal assets as well, unencumbered importantly, and importantly, the status quo order which Delhi High Court had granted previously continues. So no change in condition of those assets. The next hearing is on March 23rd. Back to you.
Boutique hotel chain Lemon Tree Hotels has seen some strong growth since it launched a little over a decade ago, and it now wants more. CNBC-TV18's Priya Sheth and Kritika Saxena report that to this end, the company is getting ready for a 1,200 crore rupee initial public offering.
Over the last 10 years, Lemon Tree has established itself as India's largest hotel chain in the mid-price category. This growth has given the company's investors the opportunity to cash in on their investment. This will take place through a 1,200 crore rupee listing on the Lal Street. The offer for sale is likely to see long-time investors like private equity fund Warburg Pincus putting up a portion of their stakes on the block.
Warburg has been invested with us since 2006, so their fund life is over. So they will be exiting a part of their stake. So I expect them to sell about 12% of the issue, which is, as I said, 20 to 22%. And some friends of mine who invested with the company way back in 2005 and 2006, after I had started it they will also be exiting a part of their stake.
The promoter, however, is not selling his stake in the company and says the 4-year plan to expand Lemon Tree's footprint to 72 properties from the current 45 will not need any special funding either.
We are going to add about a little under 3,000 rooms in the next 3.5 years in the company, of which about 2,000 rooms, about 1,500 rooms are owned by us and 1,500 are rooms that we will manage. So the funding required for these 1,500 rooms is about 2,000 crores. And as I said, we are fully funded as far as equity goes. We'll be borrowing for the balance. And when all this gets done, we'll be a little under 8,000 rooms in India.
Tell us which cities or possibly the smaller towns that you're looking at in which you would like to expand your presence, and which categories would you be opening up a bulk of your hotels in?
So right now, the next 27 hotels we are opening, among them the owned hotels, which is will be mostly in Bombay, Pune, Udaipur, Calcutta, Dehradun and Hyderabad. The rest of the hotels are in other cities, mostly Tier 1, Tier 2 and Tier 3 towns.
The company is banking on this expansion to not only ramp up its compounded annual growth rate beyond the current 18%, but also remain in the black. In Mumbai with Priya Sheth, Kritika Saxena.
Let's get you a CNBC exclusive now. A day after releasing his annual letter to shareholders, Warren Buffett sat down with Becky Quick to chat about his company, Trump's tax plan and markets. Warren Buffett told Becky Quick that overall Berkshire Hathaway is net buyer of stocks. He also told Becky that he's not concerned with the day-to-day movement of stocks, but believes that he will always prefer buying stocks over buying government securities.
Well, overall, is Berkshire a net buyer or a net seller of stocks right now?
And so far this year, we've been a net buyer, although we sold a chunk of Phillips to get below 10%. So that was a $3 and a fraction billion.
I think it was $3.3 billion.
Yeah, so we bought more than that on.
Really? So even with that purchase,
right,
that sale, you've still been a net buyer. Is
correct,
that because of the huge spikes in volatility and the big declines we've seen in the market?
No, it's just because we found stocks that we like. If we buy something, we don't have the faintest idea whether it's going to go up next week or next month or the next minute. But if I like it, we buy it. And we've got 170 billion of stocks. I mean, there's plenty of stocks we like. We have not found businesses that, because you have to pay more than the stocks are selling for if you buy in the public market by some margin. And we just haven't seen anything to buy there.
And we shall get you more from that exclusive tonight at 7 p.m. only on CNBC-TV18. And with that, it's a wrap on this edition of Reporter's Diary. Many thanks for watching, but do stay tuned. Coming up next is Market Masters.